Kyle Odell here with EdgeRock Wealth Management. I want to talk to you for a moment about one of the biggest problems I see in a lot of portfolios right now. And a lot of families are looking at their portfolio and seeing that, hey, this year my portfolio is up. But when we peel back the curtain a little bit and we really segment that portfolio into stocks and bonds, I ask families all the time, what's the purpose of a bond? And the biggest answer I get, or the most popular answer is, well, they're meant to be safe. And that answer is partially true, but the biggest or primary purpose of a bond is actually to produce income. And when we look at how bonds are performing right now, they're not doing a very good job of that. Collectively, maybe your entire portfolio is doing well. But when we peel back that one piece, what we're seeing a lot of times is they're struggling. So what I want to talk to you about here are some bond alternatives and maybe some answers that we can come up with to produce income and continue to find some safety. So when we're looking at bonds, the 10-year government bond going back to 1955 from all the way up through 2019, a little bit better than 5.8%, and that would be fantastic. We'd all take that all day long right now. That would be great. The challenge is bonds aren't performing quite at that rate right now, and when we're looking at it, overall, this is a recent study by BlackRock, and I think you could really look at any company out there and their projections and studies on bonds and how they project into the future. And I think we'd come up with very similar answers here in this. And when we look at the aggregate bond index, okay, what we're expecting, what according to BlackRock's analysis here, would be about 1.8% over the next 10 years. And again, I think a lot of companies would come up with some similar numbers to that. Now, when we look at 1.8% and you take into account inflation that's probably exceeding that over time, and you have to pay taxes on growth, we're probably falling behind here. We're not doing very well. So bonds are not doing their job. So we need to find an alternative here. And when we look year to date and we peel back that curtain, so this is from January 1st of 2020 through mid-July, the aggregate bond index is down about 1.5%. So that really causes, an issue there when we look at that piece of your portfolio and see that that part isn't doing well. So what's an alternative? And what are some things that we can really look at here? One of the alternatives that we've used for years are fixed index annuities. Now, an annuity primarily has been used over the years to create guaranteed income like a pension. We like to use them primarily as a bond alternative, where we're trying to, over time, make that between 2 and maybe 6% rate of return, so we have a safe place to park cash, a place that isn't as affected by the market, and we can always go there to withdraw income in a pretty predictable way. So a couple of there are a lot of different indices that are available inside of these fixed index annuities. One that we've used over the years is the Barclays Cape-Shiller Index. You can see year to date it's done very well, and over time since its inception has done very well. Now obviously, it's done very well, but and we're not making any predictions or projections on future rates of return because none of that is guaranteed. This may perform at a 0 rate of return minus any fees and so forth. But what we're trying to do, like I said, is find that bond alternative. Obviously better than bonds year to date than the aggregate index. Another one that we've used often through Nationwide is the JP Morgan index here. It's done very well over time. Also through Nationwide, the Zebra Index, again, done very well over time. And Morningstar, the Wide Moat Barclays Index, again, done very well. And all these different indices here, typically how they work is you get a percentage of that index. Some of these indices here, you get the full participation. Some you get a percentage, maybe 70%, 90% of that performance on the index, minus any fees. Some of them have fees, some don't. Most of them that we use do not have any fees at all, so you just get a percentage of that index. The one that we has the highest fee has a 1.5% annual fee. Just depends on what we're trying to accomplish, what need do you have, and so forth. And again, just looking at concept here, when we look at the red line, the stock market going back from 1998 through 2019, we've got the tech bubble drop, we've got the 2008 recession, but a fixed index annuity, again, just concept. This is, the blue line is capturing 50% of the upside of the market. A lot of the fixed index annuities will capture 30, 40, maybe 50% of the upside of the market if we use that S&P index. Just depends on what we're trying to accomplish. But what we're looking at is whenever the market drops, your account will stay the same in value minus any fee. In this case, we're not showing any fee on here, which is how most of them work. But whenever the market does go up, we're capturing a percentage of that upside. A lot of times 20, 30, 40, 50% of the S&P or some of those other indices that we just discussed. Sometimes you get a higher percentage on those, 70, 90%, and so forth. But again, all we're trying to find is a bond alternative. If you have questions, or if you want to explore this further, hop on our website at www.edgerockwwealth.com. You can hop on there and get some more information and schedule a quick 15-minute phone call where we can discuss your options, figure out what's appropriate for you. We'd love to have that conversation. Thank you. Take care.